Hello everyone, hope you all are doing well. So in today's lecture, we are going to start consolidated statement of cash flow. In the previous lectures, we have covered the basics of the consolidation, then consolidated statement of financial position and consolidated statement of profit and loss with other comprehensive income. We have solved so many past paper questions and each and every topic examples as well. So if any students have not covered the previous lecture, so it's a prerequisite for this lecture to please watch the previous lecture because the concepts and the basics of the consolidation is same for all the cash flows, statement of financial position, statement of profit and loss. So in today's lectures, we are going to discuss the consolidated statement of cash flows with the past paper questions as well. So if any student is facing difficulty, you guys can talk to me. So okay guys, this is IAS-7 cash flows. Before starting the definition and theory regarding to cash flows, why cash flow consolidated statement is important. Let's go through the few pointers. IAS-7 Consolidated Statement of Cash Flows. Let's say P company acquires 70% shareholding of S company at $7,000. Ordinary share capital of S company is 10,000. So it means out of 10,000, 7,000 is related to the P company and the 30% is owned by the NCI, that is 3,000. Now, do everything from group point of view. Okay, this is the consolidated statement of cash flows. The 7,000 will not be recorded as it is an inside the group transaction. Again, repeating, the 7,000 will not be recorded as it is an inside the group transaction. Means it between the group owners, it between the group. So that's why it will not be recorded in the group consolidated statement of cash flows. Purchase of subsidiary for 100 million, but that subsidiary contains 5 million cash in it. It means you are going to acquire a subsidiary and that subsidiary has a surplus or a cash balance of $5 million. So what do you think? What is the net outflow you have paid in order to acquire the subsidiary? You are giving a subsidiary 100 million and in return you are taking that subsidiary and that subsidiary has a $5 million cash. So the net outflow is 95, not 100, because these are the transactions which are tested by the examiner so frequently. So you have to be attentive. Now, the net cash outflow of the P company is 95 from growth point of view. It's just like you have bought a lottery of 50 and there are 5 free vouchers of 2 each. So total free vouchers worth is 10. 2 5s are 10. So the net outflow is 40. Why 40? Because you are paying the $50 and in return you are getting the 5 free vouchers of $2 each. So the total worth of the free vouchers of 5 free vouchers is 10. So the net outflow is 40. This issue can come vice versa as selling subsidiary net inflows 45 million. This we have studied with regard to the purchase of the subsidiary, but what if we are going to sell the subsidiary? Then the case will be reversed. Now start the consolidated statement of cash flows. A consolidated statement of cash flows consolidate the cash inflows and outflows from a parent company and all its subsidiaries, presenting them as if they operate as a single economic entity. We all know in the consolidated statement of cash flow, we have to add back the non cash items such as expenses and deduct the non-cash income as well. It reflects group level operating, investing, and financing activities. Operating activities such as gratuity payable, or you can say working capital item, inventory, receivables, payables, tax payables, interest payables, and there are other payables as well. If I talk about from the IFRS 2 share based payment, or IAS 19 employee benefit, then you have studied that there is a contribution. So that also deducted from the operating activity. These relates to the operations. Investing means if we are investing in the property, plant, and equipment, in the intangible assets, or in others such as dividend. So these are the investing cash flows. And financing means loan, share capital, share premium, dividend to NCI, dividend paid by P company. With intercompany transactions eliminated to avoid double counting. Core components sections. So we all know there are three core components. Operating activities captures cash generated or used in the group's main business operations, such as receipts from customers' payments to suppliers and employees, and interest and taxes presented by either the direct actual cash received payment or the indirect method. Starts with the net income, then adjust for non-cash items and changes in working capital. Investing activities tracks cash used for a generated from long-term investment, purchase or sale of assets, acquisitions or divestments. Financing activities records cash flows related to the group's capital structure, issuing or repurchasing debt or equity, paying dividends. Net change in cash and cash equivalents adds up all three sections to show overall cash movement during the period and reconciles it against cash balances in the consolidated balance sheet. This is the last step. After that, our balance will be tally, means match. Key consideration of consolidations: eliminated intra-group transactions. Any cash transactions among companies in the group, like intercompany sales, loans, dividends, are eliminated in consolidation to avoid misleading cash flow totals. Remember, in the first slide, I have mentioned the first point that the subsidiary acquired by the P company at 7,000, and this 7,000 will not be included. Foreign subsidiaries and currency translations, don't worry, this will be the next topic. Step by step preparation: prepared individual cash flow statement in each entity's functional currency, translate them into the group's presentation currency using exchange rates same as used in income statements. Any translation discrepancy between opening cash plus net movement and closing cash becomes the effect of exchange rate changes. We all know balance sheet item will be retranslated according to their day spot rate. And the during the year means expenses or income are retranslated using the average rate of that specific date. Ownership threshold. Fully consolidated subsidiaries, typically over 50% owned, have all their cash flows aggregated, means club them. For minority threat interest or associates less than 50%, only cash flows such as dividends appear in investing activities. Quick recap table. Component definition: operating activities, cash flow from core business, investing, purchase or sale of long-term assets, financing, capital structure changes, consolidation, adjustments, eliminate intercompany flows, translate foreign cash flows, reflect minority interest appropriately. So guys, this is the all theory related to consolidated statement of cash flows. Now we are going to start with the question number one, which is Warrburt or Warburtt, something like that. Yeah, it's Warburtt. Okay, revision of associate As P company acquired 30% shares in A company, means associate company, opening retained earning of associate is 10 and closing is 30. The profit after tax is 20. Carrying value of investment in associate. You have covered this with me in the previous lectures. Cost of investment plus post profit of a company. In this case is 6. How 6? 20 is the PAT 20 multiplied by 3. Impairment of investment in associate, if any, you have to deduct it. Dividend from associate, if any, you have to deduct it. Why deduct it? Because income is already booked. Now, in the consolidated statement of cash flow, the Recon's approach is to make a T account of each line item. This will help you in the solving the consolidated statement of cash flow questions. I have a separate sheet of all the T accounts. If any student want that particular sheet, after that you just have to enter the data and your balancing figure will be calculated. Then the balancing figure you just have to input in the correct activity account. Once you do this, your consolidated statement of cash flow questions will easily be solved. So if any student want that particular sheet, you have to comment down, otherwise I will not send or upload on the drive as well. So it's up to you now, guys. Investment in associate, opening balance, cash, post profit, impairment, dividend. Then the balancing figure will be closing. If there is a closing, then of course the balancing figure will be any of them if anything is missing. But these are the items which have been incorporated in the investment in associate account. Just these items, okay? Tax paid, opening plus tax expense plus revaluation reserve if there is any. Cash means the paid, tax paid, the balancing figure will be carried down, means closing balance. Okay, this opening is include both current tax as well as deferred tax. Remember IAS 12. Same goes for the closing balance. This can be deferred tax and current tax. In tax paid, the opening can be deferred tax and current tax. Same with the closing balance. Don't worry, this concept is tested in this question. Let's start the question number 1, Warburg. Just check the question. This is the SOFP, then SOPL, then SOCIE, SOCI, then the adjustments. Oh my God. Let's start with the part A. Prepare a group statement of cash flows for Warburg for the year ended 30th November 2008. In accordance with IAS-7 statement of cash flows using the indirect method. Okay, guys, using the indirect method. Let's start with the adjustment number 1, because in the consolidated statement of cash flows, the adjustment will help you in solving the questions. Don't go through all the previous statements because these are not recommended. The recommendation is to always start with the adjustment. First, pick the adjustment number 1. Warburg holds investment in equity instrument. Now, this adjustment gives us the idea that this is something about the investment in equity instrument. So, it might be IFRS 9. Let's go through further. These financial assets, now it is 100% sure that this is about the IFRS 9. These financial assets are measured at fair value. Much clear from this line that this is IFRS 9 financial instrument and the category is financial asset recorded at fair value through OCI. The following schedule relates to those assets. Balance on 1st December 2007 150. Then sales of financial assets at fair value through OCI at carrying amount 38. Gain on revaluation. This is a fair value change. Remember, in the case of equity instrument of financial asset, the change in fair value should be reported to OCI, other comprehensive income, and in the equity, it is goes in OCE, other component of equity on a revaluation. Then the closing is 142. Okay. The sale proceeds of the financial assets at fair value through OCI were 45 million. Profit on the sale of these financial assets is included within other income in the financial statements. Deferred tax of 3 million arising on the revaluation gain on fair value change above has been taken into account in OCI. Of course, the deferred tax of revaluation will goes in OCI because it's not part of PNL. You have to be sure about the matching principle. I have explained all these things in the IAS 12 lecture. If deferred tax arises on a particular class of asset or liability like income or expenses, so you have to make sure that their account. The profit held in equity on the financial assets at fair value through OCI that were sold amounting to 24 million has been transferred to retained earning. Remember, in case of equity instrument of financial asset, on the disposal date, all the previous equity will be transferred to retained earning. I will attach the IFRS 9 lectures link here or there for your better understanding. Now we are done with the adjustment number 1. Let's solve the adjustment number 1. So guys, this is the adjustment number 1. First, you have to make the investment income account. Opening 150 given in the question, disposal 38, gain on OCI 30, closing down 142. In this T account, there is no balancing figure. Why? Because all the figures given by the examiner. Now, there are following entries which we have to make. First, disposal entry. Bank means disposal proceeds 45 million, which the Warburg get on the sale of this investment. The investment carrying amount is 38. Look, this one we have entered on the disposal side, on the credit side of disposal. Investment 38. So the balancing figure is gain, which is goes in PNL of 7. Why in PNL, not in OCI? Because we are selling it. This is not a change in fair value. Change in fair value will goes in OCI/OCE. Now fair value change entry. Investment debit 30, OCI credit 30. Look, this one. Deferred tax entry on this revaluation gain. Tax which goes in OCI, that's why I have written OCI in the credit. This is the deferred tax expense which goes in OCI and against it deferred tax liability by 3 million. Why deferred tax expense, not income? On income, we pay the tax expense, and on the expense, we get the refund. So that's why this is the deferred tax expense on the revaluation gain. Now, as per IFRS 9, on disposal, all previous equity has been transferred to retained earning. So the last entry is revaluation surplus debit, retained earning credit by 24 million. Why the one equity component is shift into another equity component, not in a P&L item or in other head as well? because this is the equity transactions, and equity transactions will remain in equity column. Now we are done with the adjustment number 1. Let's go through the adjustment number 2. Look how easy it is. Consolidated statement of cash flows is the most easiest question. Even though it's a little bit lengthy, but it's the most easiest question. You just have to put the data in the T account and your balancing figure will come. Adjustment number 2. First adjustment is relates to IFRS 9. Now the adjustment number 2. The retirement benefit, IAS 19. The retirement benefit liability is shown as a long-term provision in the statement of financial position and comprises the following. Liability at 1st December 2007, 96 million means opening balance of the DBO. Expense for the period $10 million. Contributions to scheme paid $10 million. This is paid, so it will be deducted from the operating activities. Remeasurement component losses. It's a OCI item. It's an OCI item. The liability at 30th November 2008 is 100. So again, the examiner gives you all the data and all the transactions. Now just you have to make the entry. The benefits paid in the period by the trustees of the scheme were 3 million. Benefits entry is DBO, debit, plan asset credit. There is no tax impact with regards to the retirement benefit liability. Now, the opening is 96 and the closing is 100, so it is increased by 4 million. So the first entry you have to make is DBO credit. Why? Because the liability is increasing, so we have to record it on a credit side. It's a payable. Liability DBO credit by 4 million. Now there is an expense of 10. This is a P&L item. So P&L debit by 10. Again, there is a remeasurement component losses. This is an OCI loss. So OCI debit by 4. Now 10 plus 4 is 14 and the 4 we credit by the liability amount. Now there is a balancing figure of 10. The balancing figure is relates to the contribution to scheme, means cash credit. We have paid this contribution. Look, it's written paid. So the cash will also be credit. Cash credit is 10, liability credit is 4. It's 14. Expense debit P&L 10, OCI loss credit, debit 4. So 14 is equal to the credit side 14. Let me show you this entry as well. Look, this one. P&L 14, OCI 4, cash 10, DBO 4. This is how you have to solve these questions. Now the adjustment number 3. The property, plant and equipment in the statement of financial positions comprise the following. Carrying value. This is not on a cost. This is on a carrying value, means net book value. Okay. Carrying value at 1st December, it means depreciation is accumulate depreciation have been deducted. That's why this is a net book value. Carrying value of opening is 360. Then there is an addition 78. Gain on property revaluation, means PPE debit, revaluation surplus credit by 4. Disposal 56. This is not a disposal proceeds, guys. This is a disposal of the carrying value. Carrying value means the plant or the other PP item which has been disposed on this carrying amount. This is not the disposal proceeds which you have get from the customer. Depreciation 36. The closing balance is 350. Now, plant and machinery with a carrying amount of 1 million had been destroyed by fire in the air. If anything is destroyed, so the amount goes into P&L. Why? Because it's a loss. So P&L debit, PPE credit by $1 million. But the asset was replaced by the insurance company with plant and machinery, which was valued at 3 million. Now the insurance company came and asked the Warburg that I will provide you a replaced PPE with the old PPE which have been destroyed. The old PPE which was destroyed, the value is 1 million. The insurance company provides a replaced PPE with a value of 3 million. So the net PPE, the net value of the PPE is 2 million. Why 2 million? Because the replaced PPE's value is 3 million and the old PPE's value is 1 million. So the net balance is 2 million. So the adjusting or the net entry is PPE debit, P&L credit by 2 million. Why P&L is credited by 2 million? Because in the destroyed asset case, we debit the P&L because there was a loss of 1 million. But now the insurance company is providing us a replaced asset with a 3 million. In that case, the individual entry of the replaced item is PPE debit by 3 million, P&L credit by 3 million. But the previously we have passed the entry of P&L debit and PPE credit by 1 million. So the net entry, the net adjusting entry is PPE debit and P&L credit by 2 million. The machines were acquired directly from the insurance company and no cash payment was made to Warburg. Now this is all income. The company included the net gain on these transactions in additions at cost and other income. Okay. The disposal proceeds were 63 million. Now this is the disposal proceed which you have to compare with this carrying amount, and the balancing will be gain. Why gain? Because you are going to sell the value of the asset which is 56 million, but now you are selling it at 63 million. So of course there is a gain which will go in P&L. The gain on disposal is included in administrative expense. This is incorrect. Deferred tax of 2 million has been deducted in arriving at the gains on property revaluation. This one. The remaining additions of PPE comprise imported plant and equipment from an overseas supplier on 30th June 2008. Okay, this is another addition which is imported addition. So of course there is a foreign currency translation, means foreign currency exchange gain or loss. These transactions will be treated separately. The cost of the PPE was 380 million dinars at the date of acquisition, with 280 million dinars being paid on 31st October 2008 and the balance was paid on 31st December 2008, but the year end of the Warburg is 30th November 2008. So now these are the following exchange rates. 30th June 2008 is 5, means dinar to $1 is 5 dinar to per dollar. 31st October 2008 it's 4.9 dinar to per dollar. 30th November date is 4.8 dinar to per dollar. Exchange gains and losses are included in administrative expenses. Let's solve the adjustment number 3. First, you have to make a T account of the carrying value of net book value of PPE. Opening 360, addition 78. This is not the additions of the foreign transactions. Okay, guys. Addition given in the question. Adjustment number 3, 78, revaluation surplus 4, disposal 56, depreciation 36. The closing balance is 350. So again, there is no balancing figure in this case as well. Why? Because all the figures have been given by the examiner. Now revaluation entry, plant debit, revaluation surplus credit. Look, this 4. Deferred tax on this revaluation gain, tax on revaluation goes in OCI because it's a component of the OCE. It's a component of an equity item. Against it, you have to book deferred tax liability. I have explained earlier why deferred tax expense, not income. Then the insurance of damaged assets. This is the replaced item entry. New PP 3 million, debit PNL 2 million, old PP 1 million. The PNL is a balancing figure. If you want to pass a net entry, then the net entry of insurance is PPE, debit PNL, credit by 2 million. Now, gain loss on disposal entry. How gain loss on disposal entry is calculated? Bank is debit by 63. This is the disposal proceeds. Disposal proceeds debit 63. You have to credit the, I think the word file have not entered the carrying value of the disposal. So the carrying value of the disposal is 56. So 63 minus 56, the balancing figure is again, which is P&L 7 million. Now, foreign transactions, convert it into home currency. On the acquisition date, just convert it into home currency, means into dollar. PPE debit payable credit by 76. The dinar figure is 380 and the exchange rate of dinar per dollar is 5. 5 dinar per dollar means 5 dinar divided by $1. So in order to convert into dollar currency, you have to divide it, dinar divided by 5 dinar per dollar, you will get the $76 figure. Why not multiply? You will only multiply it if the exchange rate is $5 per dinar. But in this case, the exchange rate is 5 dinar per dollar. So we have to cancel the dinar impact with this dinar figure. That's why you have to divide it. Payable credit by 56 million. How 56 million? Remember, on the 30th October, it's mentioned that the 280 million dinar amount was paid. At that date, the exchange rate is 4.9. So 280 divided by 4.9 is cash. But the exchange rate on the date of this transaction is 5. So 280 divided by 5 is 56 million. If you pay 280 on the date of acquisition, then you have to pay 56. But now you are paying it on 30th October 2008, and on that the exchange rate is 4.9. So you are paying $1 extra. That's why there is a loss of $1. Now you are just left with 100 dinar, which will be paid on December. But the year end is 30th November 2009. So that's why we have to record it on 30th November 2009. And the exchange rate on 30th November 2009 is 4.8. Again, if you pay the $100 dinar in the October, then the exchange rate was 4.9. But now you are paying in the later month, and that month the exchange rate is 4.8. So 100 divided by 4.8 minus 100 divided by 4.9, there is a there is a loss of $1 as well. Guys, I will not go into much detail regarding this concept because I have covered all the sufficient and extra thing in the standard topics which have covered previously. That's why I have explained in my every lecture that the previous standards are very, very important. If any student wants further clarification on it, then the only way to approach me is to comment down below this video. I will contact you there. Now we are done with the adjustment number 3 as well. Now we are just left with two adjustments which are very, very small. Adjustment number 4, Warburg purchased a 25% interest in an associate for cash on 1st December 2007. So this is investment in associate IAS 28. The net assets of the associate at the date of acquisition were 300 million. The associate made a profit after tax of 24 million and paid a dividend of 8 million out of these profits in the year ended 30th November 2008. Assume a tax rate of 25%. Okay, guys. So now there is few line items which are missing. If you remember the investment in associate case, we have to calculate the carrying value of the investment in associate. And the carrying value of the investment in associate is calculated by cost of investment plus post profit of A company. Then you have to deduct the impairment if any and the dividend if any. Now in this adjustment, there are two items. The post profit of the associate company and the dividend, but there is one major item which is missing, which is the cost of investment. So in this case, we have to calculate the cost of investment. Let's see how to calculate the cost of investment. So this is adjustment number 4. Opening. There is no opening. How you guys can identify there is opening or closing? Wait a minute. Just scroll above and go to the statement of financial position. Look, investment in associate, there is no opening, but there is a closing of 100. Let's go to the table or the T account again. Look how easy it is. Now there is no opening, but there is a closing of 100. So you have to enter in 100. I have written given in the SOFP. Now associate share of profit. The Warburg acquired 25% and the profit is 24. So 25% multiplied by 24 is the 6. Now there is a dividend. The dividend is 8, but we have to take those figures on which we have acquired these shares. The shareholding of the Warburg in this case is 25%. So 25 multiplied by 8 is 2. Once you add, delete all these figures, then the balancing figure will be cash $96 million. Now let's do the last calculation for the working for interest and tax paid. Opening given in the SOFP. Closing will also be given in the SOFP. You can see opening 68, closing 63. Tax expense which we have taken in the SOPL, statement of profit and loss. 29. Deferred tax on revaluation. There were two deferred tax on revaluation. One for the adjustment number 1 and the second one for the adjustment number 3. Means IFRS 9 and PPE. So 3 plus 2 is 5. The balancing figure is the cash tax paid, which is 39, which we have to deduct from the consolidated statement of cash flows operating activities. Now interest payable, opening given in the SOFP, closing given in the SOFP as well. Interest expense we have taken from the SOPF. The balancing figure is interest paid, means cash, which is $8 million. Look guys, how easy it is. Now we are just done with all the adjustment. Now just need to enter the data in the structures and you will get your answer. Let's start with the consolidated statement of cash flows. In this case, there is no profit before tax. In this case, we have loss before tax, 23 million. Let me show you from where I have took this figure, 23 million loss before tax. This is from the statement of profit and loss. Look, this one, 23 million. Now in this 23 million, all the expenses and incomes are included. Now we have to check one by one. It's a non-cash expense or a non-cash income. If it is, then we have to deduct the non-cash income and add back the non-cash expenses. Okay, guys. So, loss before tax, it's always start with the profit before tax or loss before tax. In most of the cases, there will be profit before tax, but in this question, there is a loss before tax. So we have entered the loss before tax 23. Now adjustments for depreciation is 36 million. Look, I have written the reference number as well. Adjustment number 336. Gain on insurance is 2. It's again non-cash, so that's why we are deducting it. Adjustment number 3. Gain on disposal PPE, adjustment number 3, deduct 7. Exchange loss 2. How to? There were 2 exchange losses. Remember? So 1 plus 1 is 2. DBO, defined benefit obligation expense, adjustment number 2, 10. Interest expense 9, which we have just calculated in the last working. Gain on investment disposal is 7. You have to deduct it. This from the adjustment number 1. Associate share of profit is minus 6. You have calculated in the investment in associate account. Also, this is given in the SOPL. You can also took this figure from the statement of profit and loss account. Adjustment number 4, impairment. Adjustment number 5, given in the adjustment number 5 that there are 2 impairments. So once you add these 2 impairment, it will become 32. Look, 20 plus 12 million. Okay. So 20 plus 12 is 32. The sum of all these is 44. Once you add 23, 36, 2, 7, 2, 10, 9, 7, 6, 32, the total would be 44. Now working capital adjustments. Decrease in inventory is, it's not inventory, it's inventory. Decrease in inventory is 63. Decrease in inventory means our inventory movement is strong. It's not a slow moving inventory. Why? Because the inventory closing down balance is decreasing. So it means the inventory position is good. The inventory cycle is moving good. That's why decrease in inventory is added. It's in a plus sign, 63. Decrease in receivable means the amount due from the customers is returned by, means the customer is going to pay us the amount which they were owed. So again, decrease in receivables, it's a good sign. It's improving the operating cycle, cash operating cycle, 71. Decreasing in payable. Decreasing in payable means the amount which are payable on us to the supplier. Now we are paying them. So it's not a good sign for the company that the company is frequently paying their liabilities. It's affecting the cash operating cycle. We are doing this with respect to working capital. Okay. So decrease in payable, it's not good. That's why we have deducted 86. Okay, now we are done with these 3 working capital adjustments, but let me show you how we have calculated the 63, 71 and 86. Go into statement of financial position, in which you can see there is a inventory. 198 minus 135 gives you the balancing 63, which we have entered in the decrease in inventory. Look, trade receivable is also decreasing, 163 to 92. Okay, you guys can ask questions why we are not incorporating the cash and cash equivalents. This is the IAS-7 cash flow. So all the activities balance added together, then we have to add or delete it in the opening of the cash and cash equivalent, and the balancing or the adjustment figure will be equal to this closing figure. If it is according to or matching with this 312, so it means we are going good.
Also, you can ask why we are not incorporating these figures. This is about the investing activities, the next activity in which we will enter their balances, which we have identified in the adjustment forms. Okay, now equity and the few liabilities such as long-term loans, which we will incorporate into financing activities. Okay, there is a current liability in which we have a trade payable. 180 is the opening and 115 is the closing. Let me show you one thing. 180 is the opening and 115 is the closing. Again repeating, 180 is the opening, 115 is the closing, but here it's written 94. Why 94? If you remember, in the foreign exchange transaction there was a payable of 21. So in the closing figure you have to deduct the 21 from the 115. The adjusted closing would be 94. So 180 minus 94 is 86, means your payable is decreasing. It's not a good sign for the working capital. That's why you have to deduct it. Now, cash generated from operations is 92. How 92? 44 plus 63 plus 71 minus 86 is the cash generated from operating activities 92. Now, interest payable we have calculated in the last working of interest and tax payable. 8 is the interest paid. Tax payable is 39, means tax paid by the Warburg. Contribution to plan. Remember adjustment number 2. So in the end, there is a net cash flow from operating activities. Now, cash flow from investing activities. Disposal proceeds of investment, adjustment number 1, 45 million. Disposal proceeds, why we are not deducting it rather than adding it? It's a proceed, it's a money we are taking. It's not we are investing. We invest in the form of additions, in the form of dividends, but dividend will be incorporated into the financing activity, not in the investing. Okay, disposal proceeds of investment 45, disposal proceeds of PPE 63, adjustment number 3. Addition to PPE 57, adjustment number 3. Dividend to which two? Can anyone tell me? Dividend from the associate. Carrying value of associate 96. It's a cash figure which we have calculated. Let me show you this one. Okay. Sorry. Net cash used from investing activities is 43 in negative. Cash flow from financing activities, proceeds from issue of share is 55. From where this 55 come from? Wait, let me tell you. Then there is a dividend paid by P company. It's an outflow, so that's why we have deducted. Loan repayment is 44 in the negative. Why negative? Because your opening balance of the loan was 64, but the closing is 20, so it means your liability is going down. That's why there is a loan repayment in the negative form is 44 given in the SOFP. Dividend paid to NCI 5, refer Soshi. There are 3 line items and the reference of these 3 line items is refer Soshi. Let me tell you from this, from where we have taken this figure. Okay, look this one. Statement of changes in equity. Share capital issued is 55. Look this one. Dividend total means by parent company is 9, NCI is 5. So these 3 figures which we have incorporated from the Soshi. Okay guys, hope you are getting these things. I have explained in a very simple and straightforward. Then net cash used from financing activities is -3. Then cash and cash equivalent, the last step. Total activities balance 35, 43, 55, sorry, 3, 35, 3, 43 gives you the negative total 11. Opening cash and cash equivalent from the SOFP, opening balance of the cash and cash equivalent is 323. Once you add these two, the closing is 312. And if you can compare it with the SOFP closing balance of cash and cash equivalent, it's also 312. So now it means the matching of our balance with the SOFP closing balance is same. So now we are done with this question. Now there are part B and part C. Part B is all about the theory, key issues highlighted by the statement of cash flows. I have written the answer. Now you just have to read it so that you can get better clarity and understanding. Now the part C answer is about the ethical issues on the directors of Warburg have proposed regarding the sale of the proceeds. So this is also for you. Just read it and tell me if you are facing difficulty or not. So guys, we are done with the one consolidated statement of cash flows in which I have covered all the possibilities. There are few more questions which we will cover in the further lectures. Also, there are few past paper pointers which are very important for you. I will attach those pointers in the next lecture. So take care and best wishes. Goodbye.